Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Right there. Ignore the numbers on the bottom here. They're a little misleading. The 24th, 23rd, we're right there. And we were basically just, again, barely breaking down below 85, but we were still at essentially that support level. So we're thinking, okay, well, all we need is a little bit of a catalyst here. Now, we might have been making the same decision the week before or even later this week, but because we didn't really know when the news was eventually going to come out. But so what traders would do is they would say, well, all right, if there is a breakout to the downside, it's going to be below 85. So if I put an entry order in down at 84.50, we have the same problem, don't we? The issue is that if the market breaks down to 84.50 or so, which is be right about here, I'm going to zoom in on my chart here a little bit just so you can see a little bit easier what I'm looking at. So if the market breaks down to 84.50, I want to get short. So I want to be put in short. Now there's a good chance in the Forex that trade is going to happen in the overnight market here in North America, because you got London who's coming online in the middle of the night here in North America, and depending on where you are, Asia is online and active in our evening and nighttime as well. There's a lot of trading going on there, so that's where a lot of that movement is going to take place. In this case, it was European news began to emerge, and and ultimately the market broke out. But you know, Forex trader, we're looking at this, we're thinking, hey, no problem. I have a conditional order in place that the market gets to 84.50. I'm going to get short, and at the same time, I probably want to put another, I probably want to bracket that so that I've got some protection that if the market reverses and goes way back up, that I'm not going to accumulate too many losses. So I want to put a stop loss up above the market. Let's say that I were to put that at 50 pips or 100 pips or whatever. And as you can see, of course, this is the example is, we would have been stopped out within a day. That's where we start to get frustrated. Now, let's go back to the daily chart here. So as you can see, the market broke down there on the 24th, this big red candle that my cursor's on. That's the 24th. That was that day we were just looking at. And then you can see this big move back to the upside that was then continued for 2 more days. So we would have been stopped out. In fact, we came all the way back to, I think, a reasonable resistance level here at about 85.5. And by then, traders are a little freaked out because they're thinking, okay, well, I got faked out here and accumulated these losses, and now the market is continuing on down. Well, the news has happened. So at this point, are we trading the news, or are we trying to catch up with the news? That's the problem that a Forex trader is facing, and this is where long options really shine. The disadvantage of long options should be pretty obvious to everybody. And if you don't know this, if you haven't traded options before, here's the big problem. They cost money to buy. So, and the premium that you pay, some of it, or if you're buying an out-of-the-money option, all of it, is this extrinsic value or time value, and it erodes from day to day. So oftentimes you'll hear traders, they'll look at it and they'll say, well, the problem is I got to pay to buy the option in the first place. And if the market doesn't move anywhere, this time value just starts eroding. And I could, even if the market went perfectly flat, I'm going to accumulate losses. So it's always a trade-off. It's not a panacea, but the advantage is worth the cost, I would suggest, especially for news traders, because of one factor. It's the underlying reason that a trader is trading the news. We're not trading the news. We're trading volatility. And we know that volatility is associated with the news. So the problem is we all try to predict what the news is going to say, and it never says what we think. So now, well, I don't know. Sometimes we're pretty close, and the market doesn't go anywhere, and so we just drop it and move out of the trade. But once in a while, and maybe let's say half the time, the volatility is really concentrated on those big events. Here's a for instance. We're coming up now, and by the way, to finish my case analysis here with the dollar yen, what if we had evaluated this not from the perspective of potentially, just a one-day trade. But we bought this a put option, back here on the 13th or somewhere towards the beginning of August. We don't know when the news is going to come out. We know there's probably going to be some news that will introduce volatility in the market. We're consolidated in this really tight range. So we could buy a put, and it gives us the staying power. So we want to buy a put that gives us enough time to be right. So we'll go ahead and buy an expiration that's not expiring in 3 days, but maybe 45 days, 60 days even, that allows the market to break out and move in our favor. So we're giving it flexibility because we have the ability to do that. So just because we have expiration coming up on Friday for September doesn't mean we have to buy an option that expires in September. We can buy an option whose expiration matches our outlook for how long we think we're going to have to wait for this particular move. Well, as you can see, if I finish my story here really fast, traders who had implemented a conditional order, such as I suggested, to get short the spot market here in the Forex, and then ultimately they got whipped out and they got a little nervous. Did they get in? Did they not get in again? It's tough to say. But those who had bought an option, so they knew there was going to be some volatility. They knew there was a chance that they could even lose their entire amount that they had invested in the option. But they bought it, and they're holding and letting the market play itself out, because that option is kind of like it almost has its own built-in stop loss because it already has a maximum amount of risk. Well, ultimately it turned out that those traders were right. And the market the last couple of days has really crashed down. So I mentioned when we first started the presentation that there's some mixed signals. There's some positive signals out there in the market, and there's some somewhat negative signals out there in the market. And if we just look at the Forex as a gauge of investor sentiment out there, we're seeing some mixed stuff. So the dollar's getting weak. I think there's some reaction to the news today, the monetary policy news today and such. But there are other factors at play as well. And so what we see is that the dollar is getting weaker against the euro, which we'd normally think, well, that doesn't seem like such a bad thing. That has lately been accompanying bullishness in the stock market. But the downside here on the dollar yen is actually that's more problematic. So that's fairly bearish. So right now we're in a situation as if we're trading stock options where perhaps blending in a few trades that are not necessarily perfectly correlated to equities might make some sense. So in other words, maybe setting up a few positions that are dollar bearish might be a good trade to make. There are two candidates we could look at that we've talked about today. On Thursday, we have a couple of key economic announcements. We've got TIC data coming out, so Treasury International Capital Flows. Now that one's usually a non-event, lags by 2 months, all this kind of thing. But when it surprises, it is a big deal. So if it's a big surprise, it really pushes the market around. Also on Thursday, we have weekly unemployment claims, which again, usually not such a big event. It's very unpredictive of market direction on the whole, except when it really surprises and shocks people. So if either of these two news announcements, which we already know in advance are coming up on Thursday, match up with any kind of a bearish bias on the dollar, we could see either the euro dollar head up very quickly or the dollar yen head down very quickly, and it could be an opportunity for us in the FX market versus trying to set up some kind of an elaborate conditional order in the Forex. So this is exactly the kind of situation at which we would use these instruments, because it gives us that kind of an advantage.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.